Matt Orton, Head of Advisory Solutions and Market Strategy at Raymond James Investment Management, joins us this morning. Matt, always a pleasure to speak with you. Thank you so much for your time. What are you making of? So he hasn't budged. There was hope against hope that ahead of the April 9th deadline, there may be some concession, a pause, room for negotiation from the United States. That hasn't happened. How does this now play out in your view?
Hey, good morning, Tamana. It's always great to join you. And I think the uncertainty continues. The market hope was that after April 2nd, or Liberation Day, as it's been dubbed, was that we would have a little bit more certainty with respect to kind of what the top line might be that we're working with, and then start the process of negotiations. But the quick institution of tariffs, not leaving any time for negotiations, and the reciprocity with respect to China and tit-for-tat tariffs and the risk that poses, that's really what's unnerving the market right now. And so it's a reminder to investors, and I've been telling my clients proactively since last week, that there's going to be a lot of ups and downs through all of this, because there's going to be a lot of hope that maybe there's a light at the end of the tunnel, and then that gets pulled away. And I think we've kind of seen little bits of that already. And so it's important not to rush into the market or buy the dips, to wait until we get a little bit more clarity with respect to where policy is ultimately going to go. And in my opinion, the only way all of this goes away is through Trump. Trump is the only one who holds the cards to say where we're going to go. And until he blinks, I don't think there's a sustainable path for at least the US equity market to continue to move higher. It's not to say certain specific stocks cannot do well. There's absolutely places that investors can hide. I think India is definitely one of those places where that can be a ballast to some of this uncertainty. But investors should remain defensive right now and really lean into quality and think about balance in their overall portfolio, fixed income, equities, making sure that you're not aggressively getting risk on too early.
I want to get your view on fixed income, Matt, as well, globally. But before I do that, the question today, as 104% tariffs kick in on China, and at least the sense right now is that they're not blinking and they're not budging at this juncture at least. And so the question really is, does it hurt the US more, or does it hurt China more at this stage? And how bad can that short-term pain be?
It's lose-lose. No one's winning through all of this. It doesn't matter who hurts more on a relative basis, because the policy in this level of tariffs are incredibly damaging to both economies. Luckily, the US economy is coming from a place of strength. If we go back even 1 month ago, hard data continued to remain strong in the US, unemployment very low, corporate earnings high, corporate profit margins at record highs. Go to China, not such a bright picture. That said, China's government has the ability to withstand some of the pressures that might be applied to it from its people, whereas in the US, that's not the case. And there's going to be elections coming up in 18 more months. And you're already seeing some politicians start to get antsy with respect to the level of tariffs that are being put in. But this level of tariffs, it just can't last. And so something's going to have to be done sooner rather than later. And I'd rather be late to the game, watch it play out and see what happens. And honestly, it's the rest of Southeast Asia that can benefit. I think we've seen peak tariffs with respect to Vietnam, Cambodia, some of the countries that had very, very high levels. I'd rather start to look for opportunities there, because those leaders are already at the table with President Trump looking to make a deal and are already putting very compelling offers on the table.
Matt, good evening. This uptick in yields and just a crazy move, right? Because one would have anticipated that it will be flight to safety, would mean massive treasury buying in the US as well. It's happening in Europe. But what explains this uptick in yields in the last 2 days?
Yeah, Neeraj, I think the uptick in yield is really just overdone downside in yield that we had last week in immediate reaction to this, because there's a weird dichotomy that's going on in the US, because the Fed is put into a box. When we initially had all of this uncertainty, growth expectations moved lower. So because of that, the expectations of that proverbial Fed put, the Fed coming into lower interest rates, started to go up. But inflation's high. Inflation expectations are very high, and the volatility around inflation expectations is even higher. So there's only so much that Powell can do with respect to bringing down rates. And honestly, if Powell does start to bring down rates very, very early, given the inflationary situation, I think that's a fairly negative signal that would send to the overall market with respect to his view on where the economy is. So I think the sharp uptick in yields that we've seen, a little bit was just taking profits on trades, but I think a big piece of it was rethinking the expectation that a Fed put was actually there, when I think it's a lot lower. That strike price is a lot lower than a lot of investors were thinking.
Matt, just one more question. By the way, I think Donald Trump early morning our times, in the last couple of hours, have said that he's going to come out with I'll use the exact term, a major tariff on pharmaceuticals so that companies come and manufacture in the USA. I don't know how that will happen, but be that as it may, the one other small answer that I wanted from you is that Democratic Senator Ron Wyden has said that he'll force a vote on repealing tariffs. And there are some Republican senators as well, right, including the senator from North Carolina who's asked that, whose throat do I get to choke if this turns out to be wrong? Is there a chance that the president's tariffs can be thwarted by a vote?
Absolutely. At the end of the day, Congress has the authority for tariffs. Congress abdicated that authority through different acts passed over the past 50 years or so. And when you look, this can get a little bit legal, but a lot of the authority that the president has used to pass a lot of these tariffs are under emergency declarations under IEEPA, which is, it's one very narrow piece of legislation. And there is definitely going to be litigation that probably goes all the way to the Supreme Court to question the legality in the first place of a lot of the tariffs. So that's, again, the message to investors is we've got to buckle up, because we're going to be in this for a while with respect to volatility. But again, there's definitely parts of the market that you can lean into that are going to be a little bit less exposed. You have very, very good yield levels still in fixed income, even though they've come down, to help balance your portfolio. Gold has provided to be an attractive hedge. There's other geographies around the world that are attractive relative to just the US. So I think investors really need to be very, very focused on the balance they have in this portfolio, and think if they're going to put money to work, especially in the US and Europe and some of these very tariff center markets right now, make sure that you're comfortable with some losses on that next dollar that you might put into the market right now. Otherwise, hide out in fixed income, hide out in some hedges, and wait until there's very compelling valuations or a good fundamental story to put that money to work. It's okay to be patient.
Be patient. In the interim, I'm just wondering what your thoughts are on the currency space, because we've seen that the offshore yuan has fallen quite dramatically. And a lot of people were looking at that currency pair, Matt. What happens from here? And what's the worst case scenario?
Yeah, I mean, China, it looks like they're going to devalue the yuan. It could be devalued very, very significantly. So that could, again, it adds just more challenges to how difficult this tariff situation could be, offsetting some of the tariffs, but also making Chinese goods slightly more competitive. When you look at just the extreme volatility you've seen induced into the currency markets, it just highlights how macro and how global of a story this is. But traditional risk-off currencies like yen, like the Swiss franc in particular, those are very attractive. And I wrote a note to clients over the weekend really talking about the Swiss franc. If you're looking for a place to hide out in the currency space, I think that's where you want to go, because it's risk off, it's a little bit less exposed to tariffs, and it doesn't have the same growth considerations like the yen does, with the BOJ might not being able to raise rates to the extent that has been expected, heading into this month and all of this tariff updates that we've had over the past week.
Matt, just final point, and just taking off on what you said right at the beginning of our conversation, that India could be a safe space to hide. How so? And what would global investors need to see tangibly to underlie what we've been talking about, that India could be better placed?
Yeah, I think more investors are seeing this. It's interesting. In conversations with clients I had over the past week, India has come up quite a lot with respect to, Modi having a good relationship with Trump, the fact that the overall GDP is very insulated from the US overall. It's a strategic geopolitical partner with respect to China, which seems to be, there's a reason why they're caught up in the most extreme tariff situation, because there is a very important geopolitical aspect to China as well. India helps counter that. But the story to India is not only about GDP insulation, good demographics, it's also the fact that the Indian markets have already had a painful correction. They've already had a 15+% pullback on the index level and sharper in the mid and small cap space. And when you look at a lot of the larger companies, the banks in particular, communication services, discretionary, outside of the information technology space, there are a lot of companies that are fairly insulated from the impact of tariffs overall. Cheaper oil benefits India. So there's a lot of reasons to look at India as a very attractive ballast to a lot of the challenges that we're seeing. And hopefully that gets foreign investor flows to finally start moving back sustainably. And I think that can create a market rally. So India is one of the few markets around the world where I would be looking to put money to work on dips and high quality companies where I do expect earnings to really start to move higher going forward, irrespective of the tariff situation.
Matt, thanks, and very pertinent last points on the Indian equity markets. Thanks so much for joining us today.